Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down the best dividend stocks in Canada for 2021. These are all stocks that I personally invest in, which pay out a generous dividend and have a long history of increasing their dividends, all while growing some capital gains as well. I've also picked stocks from different industries, giving us a well-diversified portfolio of the Canadian market. These are all established and secure stocks that you can hold onto for life and collect that passive income every quarter. In this video, I want to give an update of my favorite dividend stocks that I've talked about over the past 2 years on this channel. So make sure you check out those videos for a more in-depth analysis of each company. A lot has changed since then, so I want to quickly go over each of these stocks and give you guys an update. I'm only talking about Canadian dividend stocks today. I'll be making another video update on my favorite ETFs, REITs, and US investments. While breaking down each of these stocks, I'll be talking about dividends versus capital appreciation, the payout ratio, and the amount required to qualify for a DRIP. If you need a refresher on these basics, then click the pop-up at the top right to check out my dividend investing guide, and then come back to this video. So with that, let's start with the very first stock pick recommendation that I ever made, and that's TD, Toronto Dominion Bank, ticker symbol TD.TO. TD is actually my all-time favorite dividend growth stock, and it's easy to see why. TD is the third largest company in Canada and the second largest bank right behind Royal Bank, and you really can't get more secure or established than that. For 2 centuries, TD has been a staple of the Canadian economy, and it's one of the best dividend investments in the world. In fact, TD has never missed a dividend payment in 164 years. That's incredible. Even through the World Wars, the Great Depression, and every financial disaster since then, TD has always paid a generous dividend, and it continues to do so with a solid dividend yield of 3.63% paid out every quarter. Since I last talked about TD, they've increased their dividend once, and they'll almost certainly increase it again this year. That's because they maintain a super low payout ratio of only 40%. That's amazing. That means that only 40% of its profits go out to dividends, leaving them with 60% of their net income to reinvest and grow as a company. That's exactly what you want to see in a dividend growth stock, so you can expect to see great capital appreciation and a dividend increase every year. So let's see how much it takes to qualify for a DRIP. Remember, a DRIP allows you to reinvest your dividend and use it to buy more shares of a company rather than receiving cash. And the best part is, you don't pay any commission fees at all when you use a DRIP to buy yourself extra shares. This is the best way to invest in the long term, allowing your dividends to compound automatically, giving you true exponential growth. Right now, you'll have to invest $9,700 in TD to qualify for a DRIP. Let's go through the math. With a yield of 3.63%, our $9,700 investment gives us $352 a year in dividends, or $88 per quarter. TD currently has a share price of $87.37, so every 3 months, our dividends will allow us to purchase an extra share of TD for free. To find out how I calculated this DRIP amount, click the pop-up at the top right to check out my DRIP Explained video, where I go over the long-term benefits of DRIPs, and I provide a free Excel spreadsheet that you can use to calculate the DRIP amount for any stock you want. Looking at the share price over the past 3 years, you can see an overall upward trend, with some ups and downs. And after the market crash of March 2020, TD had a remarkable recovery, and it's already back to all-time highs. Next up, we have another favorite dividend stock, and that's Enbridge, ticker symbol ENB.TO. Enbridge is the 5th largest company in Canada and the largest in the energy and utility sector. They have a diversified income stream, including pipelines for oil and natural gas, power distribution, and renewable energy, and most of this revenue comes from long-term regulated contracts. With this reliable income, Enbridge is able to pay out a huge dividend yield of 7%, paid out quarterly. Since my last video, Enbridge has increased its dividends twice, back in 2020 and again just a few months ago. These growing dividends are expected to continue. In fact, they've increased their dividends on average by 10% every year for the past 25 years. That's amazing to see. But their dividend payout ratio is a little high at 104%. That's because they just increased their dividends, and the past year has been pretty rough for the energy sector, with volatile oil prices and disruptions with pipelines. Plus, they have been very aggressive with project expansions. Having a payout ratio above 100 isn't a good thing, but this is a short-term and recent occurrence. And this is actually lower than most companies in the energy sector right now. And with their long-term contracts and the increasing energy demand as things open up, they definitely have the cash flow to sustain and increase these dividends for years to come. So I'm not concerned. In fact, with the recent dividend increase, it's easier to qualify for a DRIP. You'll only need $2,800 invested. With $2,800 invested, the 7% yield gives us $196 a year in dividends or $49 every quarter. With the current share price of $48.20, that's enough for a free share every 3 months. Looking at the share price for the past 3 years, there are definitely some ups and downs, but they're always able to recover fairly quickly. Enbridge hasn't fully recovered since the market crash of 2020, but it's getting there, and it continues to pay out that amazing dividend along the way. Make sure you check out one of my oldest videos for a more in-depth analysis of TD and Enbridge. Next up, let's talk about the dividend stocks that I suggested at the height of the market crash back in April of 2020, starting with BMO, ticker symbol BMO.TO. I've said this before, but you really can't go wrong with any of the big 5 Canadian banks, although BMO is definitely one of my favorites. They are the 8th largest company in Canada, the 4th largest bank, and the oldest bank in Canada, founded in 1817. One of my favorite facts is that BMO has never missed a dividend payment since 1829. For 200 years, BMO has paid out a dividend every single quarter. Through wars, recessions, depressions, doesn't matter, BMO will pay you. A year ago, I suggested to buy BMO at those historic discounts, and today they have literally doubled in price. They have fully recovered, and their dividend is back to normal, with a solid yield of 3.33% paid out quarterly. This dividend is incredibly secure, with a payout ratio of only 46%, which is great to see, and we can definitely expect a dividend increase this year. Since the last video, the share price has doubled, and so it will be much harder to qualify for a DRIP. In fact, you'll need $15,400 in BMO to qualify for a DRIP. With a yield of 3.33%, that will get you $512 a year in dividends or $128 every quarter. BMO currently has a share price of $127, so that will get you a free share every 3 months. Obviously, $15,000 is a lot of money to invest in one stock, so don't worry if you can't qualify for a DRIP. Just invest what you can, and you'll be able to enjoy reliable passive income and long-term capital appreciation. Looking at the share price over the past 3 years, you can see that BMO always recovers very quickly, and it's already trading at all-time highs once again. Next up, we have Fortis, ticker symbol FTS.TO. Fortis is one of the largest utility companies in Canada, and it's one of the most reliable defensive stocks out there. They're currently paying out a great dividend of 3.64% paid out quarterly, but the best thing about Fortis is their consistency. They have a payout ratio of 73%, which is quite low, especially for the utility sector right now, and so these dividends are definitely sustainable and will continue to increase. Since my last video, they've raised their dividends, and we can definitely expect another raise this year. In fact, Fortis has increased its dividends every single year for the past 47 years straight. It has the second longest running streak of dividend raises in Canada, and there's no way that the company will risk losing that record. If you're wondering what the number 1 streak is, stick around to the end of this video. If you want to qualify for a DRIP with Fortis, you'll need to invest about $6,200 today. With $6,200 invested and a yield of 3.64%, that will get us $225 a year in dividends or $56.42 every quarter. And with a share price of $56, that will get us a free share every 3 months. Looking at the stock chart over the past 3 years, we can see a clear upward trend. And even through the market crash of 2020, we saw a very quick recovery and we're basically back to normal. Next up, we have Telus, ticker symbol T.TO. Make sure you include the .TO. If you only search for T, you'll get the American company AT&T. Telus is one of the 3 Canadian telecom giants, and as such, their products and services are always in demand. That reliable income allows them to pay out a generous dividend of 4.6% paid out every quarter. They've also committed to increasing their dividend twice a year until the end of 2022. In fact, they just increased their dividend last month. But I should note that because of this, Telus currently has a high payout ratio of 130%. This isn't the best news, but again, this is just a short-term phenomenon. The ratio is so high because of their aggressive dividend growth campaign and because of their large investment in expanding their 5G capabilities, which should boost their earnings in the long run. Also worth noting is that Telus has a dividend growth streak of 17 years, which is always nice to see. Since last time, their share price has grown, but so has their dividend, and so they're still one of the easiest companies to qualify for a DRIP. You'll only need about $2,400 invested. With $2,400 and a yield of 4.6%, you'll collect $110 a year in dividends or $27.60 every quarter. Telus currently trades for $27.50 a share, so you'll be getting yourself a free share every 3 months. Looking at the stock chart over the past 3 years, there's definitely some volatility, but an overall upward trend and a very nice recovery since the market crash. For more in-depth analysis of BMO, Fortis, and Telus, check out this video from last year. Another one of my favorite dividend stocks is Manulife Financial, ticker symbol MFC.TO. Manulife is among the 20 largest companies in Canada, and they're the largest insurance company in the country. Beyond insurance, they have a well-diversified list of financial products, including mutual funds, GICs, and mortgages. The last time I talked about Manulife was in the middle of the 2020 crash, and since then, their earnings have continued to grow, especially in the booming Asian market. Even with this rising share price, they still pay out a very generous dividend of 4.48% paid out quarterly. Even better, we can expect a dividend raise very soon, since their dividend payout ratio is so low at only 42%. That's amazing to see, and Manulife has increased their dividend every year for 8 years straight. And it's super easy to qualify for a DRIP. You'll only need about $2,300 invested in Manulife. With $2,300 and a yield of 4.48%, you'll be getting $103 a year in dividends or $25.76 every quarter. They currently have a share price of $25, so that will get us a free share every 3 months. Looking at the share price over the past 3 years, we can see an overall upward trend and a very nice recovery since the market crash, so we're basically back to normal. Up next, we have TC Energy, ticker symbol TRP.TO. TC Energy is currently the 11th biggest company in Canada and one of the largest in the energy sector. Like most pipeline stocks, they pay out a very generous dividend of 5.4%, which they just increased last quarter. In fact, they have a 20-year streak of dividend raises, which is awesome. But now to the bad news. They currently have a high payout ratio of 130%. This is in line with the rest of the energy sector over the past few months, with volatile oil prices and other disruptions, but there is some news specific to TC Energy as well. 2 days ago, it was announced that the Keystone Pipeline was cancelled. The construction was already halted earlier this year, but now it's cancelled entirely. As you can imagine, this will affect TC's earnings, and we can probably expect a dip in the share price over the next week, but this is a dip that I intend to take advantage of. TC Energy still has a massive network of natural gas pipelines and power generation, which is still extremely profitable, and the demand for energy will continue to grow even with this setback. If you want to qualify for a DRIP, you'll need to invest $4,800. Let's check out the math. With $4,800 and a yield of 5.4%, that will get us $259 a year in dividends or $64.80 every quarter. Its share price is currently $64.47, so that gets us a free share every 3 months. Looking at the stock price over the past 3 years, we can see an overall upward climb with some volatility since the market crash. It hasn't fully recovered yet, but it's getting there. Next up, we have a stock which will become the very first Canadian dividend king, and that's Canadian Utilities, ticker symbol CU.TO. To no surprise, Canadian Utilities is one of the largest utility companies in Canada, and as such, they are a great defensive stock and source of passive income. They're currently paying a dividend of 4.94% paid out quarterly, and they just increased their dividend last quarter. With this raise, Canadian Utilities has increased its dividend every single year for 49 years straight. They are the longest running dividend aristocrat in Canada, and in the next 2 years, they will become the very first dividend king in Canada, meaning that they've increased their dividend for at least 50 years straight. With such a historic record on the horizon, there's no way they'll risk cutting their dividend. But with this recent dividend raise, they do have a high payout ratio of 138%. This is much higher than usual, but we are seeing this across the entire energy and utility sector. Since this is such a short-term phenomenon, I'm not too concerned. And again, Canadian Utilities has reliable income from long-term rate-regulated contracts. And they've been spending money on improving their infrastructure. So let's hope that their earnings improve next quarter and bring that ratio down to a more manageable 70% range. The good news is that it's very easy to qualify for a DRIP. You'll only need about $2,900 invested. With a yield of 4.94%, that will get us $143 a year in dividends or $35.81 every quarter. And with a share price of $35.63, that's enough for a free share every 3 months. Looking at the stock chart over the past 3 years, you can see a reliable upward climb until the crash of 2020. Since then, there's been some volatility, but it is starting to recover. For more in-depth analysis of Manulife, TC Energy, and Canadian utilities, check out my video from last summer. If you're not sure how to actually buy these stocks, click the pop-up at the top right to watch my QUESTRADE tutorial, where I give a step-by-step walkthrough on how to buy stocks and ETFs using QUESTRADE, my favorite online broker. And if you want to get started with QUESTRADE, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. And since we're only dealing with Canadian stocks here, you can also use Wealth Simple Trade, which doesn't charge you any commission fees when you buy stocks or ETFs. It's a great platform if you stick to buying Canadian stocks, especially for beginners who want the lowest fees possible. If you use my referral link below, you'll get a $25 cash bonus when you sign up and trade at least $100 worth of stocks or ETFs. For all these stocks, make sure you're buying them on the Toronto Stock Exchange in Canadian dollars. So always include the .TO in the ticker symbol to avoid buying them in US dollars and wasting money on currency conversion fees. And to get the most out of your investment, make sure you hold these in your tax-sheltered accounts, like your TFSA or your RRSP, to avoid paying taxes on these dividends. To learn how to maximize your tax-free growth, check out my tax videos here. If you'd like to see exactly which stocks I'm invested in beyond the ones in this video, and if you want to help support my channel, hit that join button down below to gain access to my exclusive videos, like my TFSA portfolio reveal, and to see which stocks I'm buying every 2 weeks. But remember, don't just blindly follow a random guy on YouTube. Everyone has their own financial goals and circumstances. Don't just copy what I do, but I hope that seeing my portfolio might offer some guidance, especially if you're just getting started. So there you have it. Those are my all-time favorite Canadian dividend stocks in 2021. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.